Today we're going to be looking at closing entries. Closing entries are the last journal entries that you do at the end of a fiscal year that prepares your accounting for a new year. There are several different accounts that we use for closing entries. And for today we're going to use the example of glasses of water to represent each of these different accounts. So imagine that we have 5 glasses of water, a glass for revenue, a glass for expenses, retained earnings, capital stock, and dividends. And each of them has different quantities of water in them that represent the amount of money in those accounts at the end of a fiscal year. The whole purpose of closing entries is to empty out most of the glasses and consolidate them into one place and clean out a bunch of the accounts to get them ready for a new year. So you can kind of think of closing entries as spring cleaning for the accounting world. If you've looked at accounting for a sole proprietor business, you may have noticed that there are a few small changes in the accounts that we're using for these closing entries now that we're working with a corporation. The biggest difference that we see here is we no longer have our income summary account. We're using instead an account called retained earnings. The retained earnings account, as a reminder, is the account used to record any earnings that belong to the owner that are retained by the business to reinvest in future years. That's why we call it retained earnings, because they're the owner's earnings that he chooses to retain inside the business so that the business can continue to use it to reinvest into future years. So we're going to be using the retained earnings account to accumulate all of our closing entries for this example. That means that we only need 3 adjusting entries instead of the 4 that we were used to using for sole proprietors. So that's kind of nice. So here are the 3 entries that we'll need to make to close out a corporation and prepare its books for a new year. The first adjustment is to take all of our revenues and empty out that jar into retained earnings. So just imagine taking that cup of water and pouring it out into retained earnings, and now the revenue cup is empty. The second adjustment will be to do the same thing for all of our expenses. We'll empty out that cup of expenses and dump it into our retained earnings glass. And then the third step is to take dividends and dump it into retained earnings as well. Notice that we're not doing anything with the capital stock this time. With sole proprietors, we use capital as our dumping ground for all of our different glasses of water. But in this example with corporations, we use retained earnings instead because the capital stock account needs to keep its original balance, which shows the par value for all of the stock that's currently outstanding, and that number only changes if the company issues or buys back stock. So retained earnings is going to be the account we will use for our 3 entries when we're dealing with closing entries for a corporation. Now, the other thing that we need to understand is the difference between a temporary and a permanent account. So just as a review, a temporary account is any account that is used to accumulate information until it is transferred to the owner's equity account. The key words to remember for this definition are until it is transferred. Temporary accounts are the ones that transfer all their money out at the end of the year. So if we look at our glasses, now that we've done our adjustments, which ones would be considered temporary accounts? Right, it's basically all of the empty accounts. So any glasses that are empty after the closing entry, those are temporary accounts because they've had all of their money transferred out to retained earnings at the end of the fiscal year. A permanent account is any account that's used to accumulate information from one fiscal period to the next. Keyword here being from one period to the next. These are all the accounts that hold their amounts and carry them forward into the new fiscal year. So as we look at our glasses of water, which ones are considered permanent? those would be any ones that have water in them in the end. Now, these are just the 5 accounts that we showcased for the adjusting entries, but realize there's still a lot of other accounts out there. We still have all of our asset accounts and our liability accounts as well. And because those accounts retain their values into the new fiscal year and are not emptied out as part of the closing entries, those are also considered permanent accounts. So permanent accounts are any accounts that still have their values at the end of the fiscal year. Assets, liabilities, and retained earnings and capital for a corporation. Everything else, revenue, expenses, and dividends, are temporary. So let's take this into a real-world example and see how these adjusting entries would be made, or these closing entries, would be made using journal entries. So here I have a trial balance for a company at the end of the year, and we need to make our closing entries for this company. So going back to our glass examples, the first adjusting entry we needed to make was to pour out everything from retained revenue and put it into retained earnings. So if we look back at our trial balance, we only have one revenue account, sales, and we can see on here that it is a credit balance of $109,500. Remember, the goal is to get it to zero. So how would you get a credit balance of $109,500 to zero using a journal entry? Remember, to subtract out a balance in the accounting world, we need to use the opposite balance of what's currently there. So currently we have a credit balance of $109,500, so we will need to debit sales for that full amount. So our journal entry would look like this. We would debit sales for $109,500 and then credit retained earnings, essentially transferring the balance from sales into retained earnings. Now, the second journal entry is going to be to transfer the expense balance into retained earnings as well. Now, expenses, if we look at the trial balance, we have a lot of those. Now, you could do each of these as individual journal entries like we did with sales, or to save time, you could create one big journal entry, and that's what we're going to do here. So, the first thing we're going to do in creating this journal entry is to write a line for retained earnings at the top. We don't know what the balance is for that yet, so we're just going to leave it blank and continue to write in each of our expense accounts, which are going to be credit balances because, again, we're subtracting them. And since expenses are normally a debit, we're going to use the opposite to zero them out. And we're going to write them in for their full dollar amounts. So we've written in cost of goods sold all the way to the tax expenses. So all of our expenses as credits. Then what we're going to do is total all of these credits, add them up in a calculator. And whatever that total is, that's what we're going to put in for the debit for retained earnings so that our journal entry balances. So in this example, our debit is $94,200. And that's our journal entry to transfer all of expenses into retained earnings. Now the last step that we have is dividends. We're going to pour out the dividends into retained earnings as well, leaving dividends at zero. So our dividends have a debit balance of $4,950. So we're going to credit dividends for the $4,950. And then retained earnings is going to get the debit. Now, a lot of students will make a mistake on this one because they will try to look at the balance that's in retained earnings already and use that as the debit balance because retained earnings is the account. The dollar amount for each of these three adjusting entries comes from the sales, expense, or dividends accounts, not retained earnings. Retained earnings is just a plug figure to balance the journal entry and transfer the money over. So you're going to use the dollar amount for dividends for both the debit and the credit, and then retained earnings is the debit account for that journal entry. So those are our three journal entries that we use to close out our books at the end of the year. And remember, when we say closing entries or closing out our books, what we mean is we're simply zeroing out all of our temporary accounts and transferring that money into retained earnings for a corporation to prepare the accounting records for the new year. So the new year begins with $0 in net income, and we can record our earnings for that new year.